All right, let's dive in. In the world of finance, there are very few events that get more attention than a meeting of the Federal Reserve. This is where the big decisions are made, the ones that can affect everything from your mortgage to the job market. And recently, the Fed found itself in a crazy spotlight, not just for its economic policy, but for this intense political storm that was brewing all around it. So today, we're going to unpack how they navigated that pressure, what it all means for the economy, and most importantly, what it means for you.
Okay, so first things first. Let's get right to the headline decision, the big one that had markets and economists everywhere kind of holding their breath.
And there it is. The Fed decided to hit the pause button. They chose not to raise or lower interest rates at this meeting. Now, look, this was a move that a lot of people expected, but as always, it's the details behind the decision that make this whole thing so fascinating.
So the key takeaway here is that the benchmark federal funds rate is staying put, right in this target range of 3.5 to 3.75%. And remember, this is the rate that banks charge each other for overnight loans, and it has a ripple effect on interest rates all across the entire economy.
Now, you might be wondering, who exactly makes this call? Well, that would be the FOMC, the Federal Open Market Committee. The easiest way to think about them is as the pilots of the U.S. economy. They meet about 8 times a year to try and steer our monetary policy in the right direction. But, and this is a big but, the decision wasn't unanimous. Not at all. While 10 members voted to hold rates just as they are, 2 members, Stephen Mirinson and Christopher Waller, actually wanted to cut rates. And that little bit of dissent, that's a really big deal because it signals there's a very real debate happening behind those closed doors.
So that begs the question, right? Why hit pause? To really understand what the committee was thinking, we have to look at the exact same data they were analyzing as part of their really delicate economic balancing act. At its heart, the Fed is guided by something called its dual mandate. It's basically a two-part mission: keep employment as high as possible and keep inflation low and stable. It's a total tightrope walk. If you lean too far one way to try and boost jobs, you risk inflation taking off. But if you lean too far the other way to fight inflation, you could really hurt the job market.
So what was the data telling them? Well, honestly, it was a bit of a mixed bag. Inflation was hanging out at 2.7%, which is still above the Fed's 2% target. But hey, it wasn't getting worse. And at the same time, job growth was cooling off, which suggests the economy is stabilizing, not dangerously overheating.
But you can't just look at that one top-line inflation number because it doesn't tell you the whole story. When you really peel back the layers, you see this sort of tale of two inflations playing out. The price of actual stuff, goods, is being pushed up, mostly because of tariffs. But the price of services, that's actually starting to cool off.
And you don't have to take my word for it. Fed Chair Jerome Powell explained this himself. He actually called the tariff effect good news. And why? Because it's a specific external factor. If prices were going up because of red-hot demand, that would mean the economy is running too hot. And that's a much, much harder problem for the Fed to fix. And really, this quote from Powell just sums up their whole mindset perfectly. With the dangers to both sides of their dual mandate, inflation and employment, seeming to get a little smaller, the Fed feels like its policy is, in his words, in a good place. Basically, it's their justification to just stand still for a bit and see how everything plays out.
Okay, but here's where the story gets really juicy. This decision was not made in some quiet academic vacuum. No, there was a huge political shadow looming over this meeting, and it created a level of drama that honestly overshadowed the economic policy itself.
And this is the real tightrope walk we're talking about, right? You've got this quote from economist Jake Kreml that just hits the nail on the head. The real story here is the incredible tension between all this political pressure and the Fed's absolute need to be driven only by the data. For them, maintaining that credibility is everything. And we are not talking about a little bit of pressure here. Just look at the sheer scale of this. A Department of Justice investigation, a Supreme Court case about removing a Fed governor. The then president was publicly talking about who the next Fed chair might be. And of course, tons of questions about Chairman Powell's own future. I mean, can you imagine trying to make a calm, impartial economic decision in that kind of environment? So, with the Fed officially on pause, the billion-dollar question is, what happens next? And probably more importantly for all of us, what does this actually mean for your wallet? So to understand where we're going, we kind of have to remember where we've just been. Right before this pause, the Fed had actually cut rates 3 meetings in a row. So this decision to hold is a pretty big break from that pattern.
All right, so the market, as it always does, is already placing its bets on when the next cut will finally come. And as you can see, the odds for a cut in April, they're less than 1 in 3. But by the time we get to the June meeting, it's pretty much a 50-50 shot. So it really seems like the market is convinced a cut is coming. The real question is just when.
Okay, let's bring this home, literally. If you're out there thinking about buying a house, this is the part you've been waiting for. Despite all the hopes for rate cuts, the experts are pretty much all in agreement. 30-year fixed mortgage rates are probably going to stay stuck in the low 6% range for a while, only drifting down very, very slowly. And here is the final and maybe most important twist in this whole story. While the Fed's decisions are obviously hugely important, they don't have some simple on-off switch for mortgage rates. There are a lot of other factors at play. So yeah, if you're one of those people obsessively refreshing mortgage rate websites, and hey, no judgment, what should you really be paying attention to? Well, keep a close eye on the big labor market reports. Headlines about major layoffs can shift things really quickly. And then there's the more technical stuff, like what's going on in the mortgage-backed securities market. Believe it or not, that can have a more immediate impact than a Fed meeting. Which brings us right back to the central, most important question of this entire story. The data is telling one tale, but all this political pressure is telling a completely different one. In this high-stakes environment, the Fed's greatest challenge might not be balancing the economy. It might just be defending its own independence. And that is a tightrope walk we're all going to be watching.